Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 347 on January 11th, 2025. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Tilray Brands, Marathon Digital Holdings, and the iShares Trust 20-plus Year Treasury Bond ETF, and we discuss three new trades on Plug Power, DraftKings, and Riot Platforms. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the market finished this shortened trading week lower. The Dow Jones Industrial Average lost 793 points, closing at 41,938 points. The S&P 500 index lost 115 points, ending the week at 5,827 points. And now it's time for the topic of the week. The topic of the week is refocusing. As I've gotten older, there are a few things that I know are certain. One is that life will challenge you. The results of your life will largely be defined by your response to those challenges. I've had some situations recently that challenged me. Specifically, I had a couple slip-ups in trading recently. My read on how the market would digest some news was just off. I was wrong. And then I found myself defending a losing position rather than simply adjusting for the current market conditions. I finally had to walk away. And I live in Texas, and it's not often that we get snow, but we got some snow in the last few days. So I literally stepped outside for an hour and shoveled snow off of my driveway. My Minneapolis friends would have laughed at me and been impressed by the fact that I was willing to go shovel snow in the middle of the day. That was just the right amount of physical exertion and mental relaxation. I had to get my mind on something else that I needed. My mind needed a break. I came back on fire. My trading was much better than it had been in the morning, far more profitable, which was great because I needed to make that money back. And, ultimately, I needed to take a moment and refocus. There are times in life where you will have to course correct. That will happen in your trading as well. And when things are not going the way you would like, don't be afraid to hit the pause button and get refocused so that you can get the outcomes that you want. Now, let's go ahead and jump into the review of last week's trades. And as a foreshadowing, they did not work quite as well as I would have liked. So this will be a show that's full of a bit more explanation than normal. So we'll start off with our cover call on Tilray Brands. Symbol T as in Tango, L as in Lima, R as in Romeo, Y as in Yankee. At the time, the stock was trading for $1.45 per share. I looked at buying stock and selling the January 1.5 call at 16 cents. That could give me a return of 14.48% in 2 weeks. Well, shares of Tilray Brands fell 22 cents, ending the week at $1.23 per share. The call option that we sold lost 13 cents, leaving us with a net loss of 9 cents if we were to close the trade out immediately. Now, the first thing I would do is allow this trade to expire as is. You could always just buy the call back and go ahead and sell another call option with a February expiration, but you'll just be leaving some money on the table. The option appears ready to expire worthless, so let it. Next, I'd look to sell another call option against this stock with the February expiration the Monday following this January expiration. Now, you will likely capture enough money to offset the small weekly loss and to ensure a bit more profit on this trade. In general, if the stock does not go down by more than the aggregate sum of the money collected in selling these monthly call options, you will make a profit from the trade. Another way to say that is you're going to make another 10% on the same shares of stock by selling another call option next month too. So while the trade did not work out for the week, it will work out if we keep selling call options against the shares that we own. as long as the shares still stay listed as well. When you're playing in these penny stocks, you really have to stay on track of that, keep track of that rather. So that's it for the covered call. Let's get into the credit spread. We looked at a credit spread on Marathon Digital Holdings, symbol M as in Mike, A as in Alpha, R as in Romeo, A as in Alpha. At the time, the stock was trading for $19.64 per share. I looked at selling the January 19, 18.5 put spread at 16 cents. That could give us a maximum possible loss of 34 cents per spread. Now, shares of Marathon Digital fell $1.78, ending the week at $17.86 per share. The out-of-the-money put spread that we sold is now in the money with 1 week left to expiration, and that's not good. We are nearly $1 below our break-even point, and we are losing 23 cents on the spread right now. The total possible loss on this spread was 34 cents, so there's still another 11 cents of loss coming if this stock doesn't head back above $19 per share. Now, you can certainly close the trade and walk away with the limited loss of 23 cents. I'm going to walk through several scenarios so that you'll fully understand. We typically look to sell a call spread to make this an iron condor. Now, you could collect 21 cents for selling the 18.5 call spread. Of course, if the stock finished between $18 and $18.50 per share, then you would lose money on both the call and the put spread. That's not a good option. Now, you could sell the 18.5 19 call spread at 17 cents. You would recoup most of your loss from the put, but now you have sold a 50-cent box at 33 cents. You stand to lose 17 cents at expiration, no matter where the stock finishes. It's less than the current loss, but only by 6 cents, and it becomes a guaranteed loss. Now, you could also sell the 19.5 call spread at 14 cents. That would offset some of the current loss and lower your maximum loss on the trade to 20 cents. And it also creates a region where this trade could actually finish in the profit. Iron condors have 2 break-even points. So if the stock expired between $18.70 and $19.30 per share, you would actually have a profit. Outside of that range, you lose 20 cents. I lean more towards this scenario, turning it into an iron condor. It lowers the risk level from our original trade and creates a target stock range for profit. Even if you close the trade right now, you would still lose 23 cents. So creating an iron condor not only lowers the maximum loss to 23 cents, it's still better than simply closing the trade. And if that doesn't make sense to you, because I talked about the box, I talked about some of the other options, just go ahead and shoot me an email. But I at least wanted to give more of a definition. Oftentimes, I just mention the adjustments and I don't show you the rest of the math, the rest of the situations or scenarios that I considered. I'd like to do the math because it will open your eyes and allow you to make a better decision. Finally, we had the debit spread, which also did not work out. The debit spread on the iShares Trust 20-plus year Treasury Bond ETF, symbol T as in Tango, L as in Lima, T as in Tango. At the time, the stock was trading for $87.29 per share. I looked at buying the January 86.5, 87 call spread for 32 cents. That could give us a maximum gain of 18 cents, or that's a 56.25% return in 2 weeks. Well, shares of TLT lost $1.83, ending the week at $85.46 per share. The in-the-money call spread we bought is now out of the money, and I did the math on several adjustments on this one as well. You could sell the 85-87 call spread at 30 cents to turn the long call spread into a short call spread. Then you could sell the 85-84 half put spread at 14 cents to create an iron condor and a defined win-loss range. But when you do the math, it shows that you actually paid 2 cents to sell the spread because you'll collect 30 cents to sell that call spread, but you originally paid 32 cents for the original trade. You could still lose the full 50 cents on the spread if the stock finished above $86.50 per share. The 14 cents that you collect on the put spread lowers your maximum loss from 52 cents down to 38 cents. That's more than your total possible loss on the original trade. Remember, our goal is always to lower risk and or lock in a profit. So in this scenario, you would be increasing risk without truly increasing the likelihood of a profit. So I would lean towards either closing the trade outright, or simply waiting to see how the week goes with full knowledge that you could lose another 12 cents on this trade. Always do the math. Always do the math. It will keep you from accidentally multiplying the risk you have on. So that's it for the trade review of last week's trades. This upcoming Friday, January 17th, is the expiration for all monthly options in January. All new trades on this podcast will use the February 21st expiration for monthly options in February. So we're going to start off with our covered call on Plug Power Inc., symbol P as in Papa, L as in Lima, U as in Uniform, G as in Golf. The stock ended the week at $2.87 per share. I'm looking at buying stock and selling the February 3 call at 39 cents, hoping for a return of 18.12% in 6 weeks. Now you enter this trade by buying stock for $2.87 and selling the February 3 call at 39 cents. This trade makes the most money if stock prices finish above $3 per share. The break-even price on this trade is $2.48 per share. In real terms, the stock purchase will require $287, and you'll collect $39 for selling the option. Next up, we have a credit spread on DraftKings, symbol D as in Delta, K as in Kilo, N as in November, G as in Golf. Stock ended the week at $39.49 per share. I'm looking at selling the February 39-38 put spread at 38 cents. That could give us a maximum possible loss of 62 cents per spread. Now you enter this trade by selling the February 39 put at $2.37 and concurrently buying the February 38 put for $1.99. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices expire above $39 per share. The break-even price on this trade is $38.62 per share. In real terms, you'll receive $38 per spread that you sell and have $62 at risk. And then our final trade on the week is a debit spread. We're going to look at Riot Platforms, symbol R as in Romeo, I as in India, O as in Oscar, T as in Tango. The stock ended the week at $12 per share. I'm looking at buying the February 11-12 call spread for 51 cents, hoping for a max gain of 49 cents, or that's a 96.08% return in 6 weeks. Then you enter this trade by buying the February 11 call for $2.24 and concurrently selling the February 12 call at $1.73. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $12 per share. The break-even price is $11.51 per share. In real terms, you'll pay $51 to enter the spread, and your maximum gain is $49 per spread. So that's it for this week's show. Thank you guys so much for listening. Of course, last week we had, on Thursday, the markets were closed due to, or really in honor of Jimmy Carter. This upcoming week, we don't have any, I think this is the first week in a while actually, that we don't have any days off. I mean, think about it, we had Christmas one week, we had New Year's Day the next week, and then we had the presidential funeral the following week. So we've had 3 weeks of shortened trading week. I'm happy. I'm looking forward to 5 days to trade. I love trading. I don't know if you guys know that or not. So anyway, looking forward to a good, strong week in the markets. I hope you guys have a wonderful weekend. Stay warm out there. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.